Hello, and welcome to our presentation on the Sharon Laney case. Sharon's financial goals, we ordered them in terms of importance. Those important goals are at the top. And ultimately, they're things like decreased spending, providing for her mother, reviewing and updating her risk management plan, retiring, and things like that. So, in terms of savings, we would recommend that you sell your current house as well as reduce expenses. Currently you are kind of in debt each year. You have negative net discretionary cash flows, so it's like negative $28,000, and we need to figure out a way to increase that so that you can save more money for your goals. And then in terms of insurance planning, you would also need to save money so that you can buy more insurance. For instance, buying a $4.2 million life insurance policy would be important so that if you do pass away before the age of 70, you can provide for your daughter, your mother, and your granddaughter's education, and so on and so forth. Okay, and for debt management, part of the goal is to sell your current home and buy a less expensive home, and that will help you to get an emergency fund, and it'll help improve your other debt ratios. For estate planning, it's important that you cut your ex-husband out of the will and make sure you have the proper beneficiaries and the proper estate planning documents, and put your assets into a revocable living trust so that you can transfer those assets to who you want to. And then for risk tolerance and investment, it's important that we adjusted your portfolio to give you a higher rate of return that's more in line with your long-term time horizon and your risk tolerance. And it would be a good idea to try and get a higher rate of return. For education and education funding, the first alternative is to fund $30,000 a year of tuition for 4 years. This is your goal. This would cost around $4,500 a year. The second alternative is to only fund 2 years of that education. That will cost around $2,200 a year. And the reason why we have that second alternative is just because that would hopefully help her to get through a community college education at least. And if we need to reduce the amount that you spend on education funding, that should be a more reasonable goal. And the third option is to fund nothing and just have her rely on financial aid for retirement. But the first alternative is retire at age 65 and take Social Security at age 65. You'll need to save an additional $27,000 a year. So, that plan isn't the most realistic. The second alternative is better. The second alternative for retirement is retire at age 67 and take Social Security at age 67. This is later than you would want to retire because you want to retire at age 65. However, retiring at age 67 is more reasonable if you can stay on with your company at the same wage rate. The third alternative is even more reasonable. It would be retiring at age 70 and taking Social Security at age 70. And that would give you the most amount of money, and it would definitely help you to have a good retirement and have enough money to fund your mother's care and leave an inheritance for your daughter and granddaughter. One of your goals is selling your home and buying a new home. And with the estimates that we got from you in your first meeting, overall we think that you would save around $35,000 a year when we account for the cost of a lower mortgage, saving money on property tax, and saving money on homeowners insurance. For income tax, once we adjust for the sale of your house and buying the new house, and we adjust that, you'll save a net of $26,000 a year. Another goal is to try and withhold less money for income taxes if that is possible. Okay, Sharon's currently 50 years old. She's been divorced. She pays alimony to her ex-husband. Sharon also has a dependent mother. Her mother will run out of funds in 10 years, and she also wants to provide a good college education for her granddaughter. For investment information, she wants to earn an 8.5% rate of return on her investments. Unfortunately, that's not really reasonable with the numbers that we found. It'll be closer to like 6.26%. For income tax information, she's going to be under the single filing status. For estate information, she needs to update her estate documents and provide for her daughter and granddaughter. And for risk tolerance, She has a PASS score of 24. Here is a table of economic information. And right here we have inflation rates and the type of state. Here we have bank lending rates. And here we have expected investment returns. One of her goals is to decrease spending. Currently, each year, her cash flows is negative $28,000. So we need to decrease spending and increase savings so that she can meet her financial goals. We were saying if you sell your old house and buy a new house, as well as cut spending for clothing and vacations, we should be able to increase your savings quite a bit and have positive net discretionary cash flows. And then how you would spend those savings is in the insurance policies that we recommend, and then that leftover savings can be put towards putting money towards your mother's care, investing for Allison's college education, and other goals. For Lucy's care, the sale of your old house and purchase of the new house would give you around $640,000. You should save some of that money into an emergency fund. After budgeting for that, you have a good amount of money, $465,000. And to budget for your mother's care, we think that investing at least $400,000 of your remaining funds into an investment account would help provide for your mother's care. And for retirement, there's a deal with your company that would give you around 2 years of your salary after you retire. However, it's not fully funded yet, so we can't really rely on it at the moment. If it does get funded, it would be a good idea to delay withdrawals from your 401k and Social Security for 2 years. Except for in alternative 3, when you are retiring at the age of 70, you should delay withdrawals from your 401k, but you should take Social Security at age 70 if you do retire at age 70. You're already saving around $34,500 with the amount that you're saving plus your employer match. And then your first alternative is retire and take Social Security at age 65. This is not realistic because you're going to have to save too much money each year in addition to what you're already saving. The second alternative is more reasonable. It's retiring at age 67 and taking Social Security at age 67. And you would only have to contribute an additional $435 a year to make that work. And then for alternative 3, that is retiring at age 70 and taking Social Security at age 70. This is a very reasonable option because you're already saving in excess of money for retirement. So that will help you weather storms, and if there's unexpected expenses, that will help take care of that.
In 2019, you had $1,695,000 in investment assets and $1,316,667 in other assets. Her total assets are worth $3,011,667. In 2019, your total liabilities were worth $626,222, and your net worth was worth $2,385,445. In 2019, she has good ratios of assets and liabilities. In 2020, she has $55,000 in cash. She has $1.4 million in investment assets, and she has $1.2 million in personal use assets. She has $2,655,000 in total assets. In 2020, she has $44,224 in current liabilities and $655,641 in long-term liabilities. Her net worth is worth $1,955,135. She has less assets in 2020 than 2019. She also has more liabilities in 2020 than 2019. Thus, her net worth is lower in 2020. We did not make any adjustments to her 2019 taxes. However, we did adjust her 2020 taxes to reflect the lower mortgage payments on the new house. This results in Sharon getting a smaller refund, but she saves money overall. For alternative 1, Sharon wants to fund 4 years of college education for Allison. She is valuing college tuition at $30,000 a year. This will cost around $4,500 a year. For alternative 2, Sharon will fund 2 years of college education for Allison. This should be enough for a community college education. This will cost around $2,300 a year. This option is more reasonable if Sharon cannot contribute enough money for alternative 1. For alternative 3, Sharon will not fund Allison's education. If there is not enough money after saving for her higher priority goals, then Sharon will not be able to save for Allison's education.
Hi, my name is Emily Gomez. I will be going over the engagement letter, the risk management, and the estate planning having to do with Sharon's case. The engagement letter is a legal document between you and your client that has to do with how the relationship is structured, what we'll be going over, how the client is charged, and what our services are. The main part of our services is reviewing and prioritizing the goals and objectives, reviewing current investment portfolios and developing asset management strategies, developing a financial management strategy, including financial projects and analysis, completing a retirement plan assessment, including financial projects of assets required at estimated retirement date, assessing estate net worth and liquidity, identifying tax planning strategies to optimize financial position, assisting you with the implementation of the financial plan, and determining the necessity to revive your plan. These will be our main objectives. They can be changed as we progress, and if things need to be changed and revised. Now, risk management. Risk management, we are going to go over the different insurances that Sharon currently has and what she should do going forward. With life insurance, Sharon currently doesn't have any life insurance. Usually the benchmark recommendation is that with her pay, she has 4.5 to 5.6 million life insurance policy to be in the benchmark range. She doesn't have enough money currently to do so, and we recommend that once she gets to get that insurance policy, when she has enough money, which she will receive once she sells her current home. This will better protect her and her family in the long run. The next is disability insurance. She currently does receive disability insurance from her employer, but since it's from her employer, she has to pay taxes on it when she receives it, which will put her below the benchmark. So we recommend that she get more in order to be at that the industry standard. The next insurance is health insurance, and she currently has unlimited health insurance, which is the industry benchmark, and she should keep that, and she currently doesn't need any more. The long-term care insurance. It would be great if she could have it since she is 50 years old, but she does not have any money currently, and it would be bad in the long run to get it because she doesn't have any money. If she implements the savings goals that we recommend, though, she will be able to afford the premium. It won't reach the benchmark that she currently needs, but she'll at least have long-term care insurance. Next is homeowners insurance. She's currently paying a premium of $6,000 per year. We would increase the deductible from $1,000 to $2,000, and this will decrease coverage, which will save her money. But if she sells her home and buys a new home, then the insurance will need to be updated. It will probably be less due to the fact that her home is $800,000 and she's looking at more of a $420,000 house, which means there will be less liability that the insurance will need to cover. Lastly, second to last, I guess, automobile insurance, which she has great insurance for her car, and she doesn't need to increase or decrease how much she is getting or the deductible. Lastly, liability insurance. She currently does not have any liability insurance. We recommend that she does get it. It is about the benchmark is about $1 to $3 million to cover it, but we know she doesn't have enough money currently in order to afford that. So we recommend that when she sells her house or cut back on the savings, cut back on the costs, that she will be able to afford it, and she'll have less risk in her life, and she'll be able to manage that risk, which is technically is what we want in the long run. Lastly, I will go over estate planning. Now, Sharon currently, her assets are home and furnishing, automobiles, and collectibles. Currently, her will states that everything will go to her ex-husband, which is currently out of date on what her terms are, since that was created when they were first married. She will need to redo her current will in order to reflect how she would like her assets distributed when she dies. Doing this will update all her information and keep her wishes how she would like them to be done.
My name is Tiffany Ames, and I will be presenting for the Sharon Laney case on the income and expenses, the SWOT analysis, risk tolerance and investments, and the debt management and financial ratios. Sharon, currently your expenses exceed your income. Part of that is, of course, the alimony you pay to your ex-husband. We do recommend you cut other expenses so that you no longer exceed your income. You can do this by selling your current home, purchasing a less expensive home, reducing your clothes budget, and getting rid of satellite TV and using streaming services. With the SWOT analysis, your strengths are your high income, your high net worth, and your existing investments. Your weaknesses, that net deficit cash flow, you don't have life insurance, and your current unrealistic rate of return based on your risk tolerance. Some opportunities: you can increase your savings in your 401k, sell your current home and purchase a less expensive home, and the long-term growth potential in your existing investments. The threat is your inadequate estate plan, your low rate of return on investments, and inadequate savings for retirement. Your risk tolerance, you are currently only earning 4.63% on your investments. You could be earning 6.626% based on your risk tolerance test that you took, but you want to earn 8.5%, which as of right now, based on your risk tolerance, is a little unfeasible. We do suggest you wait until you're 65 to sell your Petro King interest. Diversify your current portfolio, increase your savings amount in your 401k, and either adjust your rate of return expectations or increase your risk tolerance. Your current situation with debt management is your emergency savings ratio is inadequate. You have below 3 months worth of emergency savings, whereas you need to have 3 to 6 months. Your current ratio, which includes your housing and auto loan, is currently adequate. Your housing ratio 1, which includes your housing, taxes, and property insurance, is adequate. Your housing ratio 2, which includes your housing ratio 1, your auto loan, credit card, and your alimony, is inadequate. So we do recommend that you sell your current home, buy that less expensive home, and use some of the proceeds from that sale to fund your emergency fund. Consider subscribing to a Latotes clothing service, which they offer high-end clothes, which means your wardrobe could be frequently changed without the cost of buying so many clothes, which means you could save closet space. You could also buy the pieces of clothes if you choose. You would also have less laundry to do. Ditch your satellite television and use a streaming service, which means you'd be able to choose any type of movie and TV you want, and you could avoid commercial. If you follow our recommendations, your emergency savings ratio would actually be over 7 months worth of savings, which is excellent. You could take some of that extra money that would be over this 6 months worth of ratios and use that to beef up some of your investments. Your current ratio would still be excellent. In fact, it would be far improved. Your housing ratio 1 would still be excellent. Unfortunately, your housing ratio 2 is still inadequate, but it would be much improved. And as your savings grows, it could continue to become better. We look forward to working with you, and we hope you have a good rest of your day.